Four types of events that I'll be focusing on today is 1. War. 2. Big disasters, and that includes once-off terrorism attacks that aren't part of a larger war. 3 is elections, sometimes not be classed as a disaster depending on who wins. But 4 is large-scale bankruptcies, as in the too big to fail bankruptcies that do actually fail. So first, let's get into war. On average, out of every war combined in the last half century, the S&P 500 has fallen by an average of 6.5% at the commencement of the war, but 1 year after the date of the war starting, it'll be up by 13%. And with that 6.5% fall, it takes an average of 47 days to correct to back to where it originally was. And another statistic that came out of a study is that share markets are actually less volatile, as in less turbulent, during times of war than what they are during times of peace. I know that's basically contrary to what one would assume. And for the years of war versus all the years of peace, the share market grows slightly faster during the war years than what it does during the peace year. The only exception to this was the Vietnam War. So that's basically how much war affects the share market. So here I've got some research from LPL, and which is used the S&P Dow Jones indices and basically analyze major disasters in our history. So everything from Pearl Harbor to the Six-Day War to the London subway bombings, for example. So you can basically see on screen here how much the share market is affected in both a short and long-term duration for when these events happened. And now we'll go on to large-scale disasters. So when I'm talking about disasters, I just want to make it clear what disasters actually are. So these are things that are just totally unexpected and cause a lot of damage, and they are a bit of a once-off. So things like, say, a volcano, an earthquake, or even a terrorism attack that isn't attached to a larger war. According to a 2019 study by Che Tavor and Sharon Tietler-Redjev, the share market index will move downwards for about 2 to 3 days before then just continuing on its usual trajectory. And that could mean further downwards as well. If the market was going upwards and there was a bit of an unexpected disaster, it will go down for about 2 or 3 days and continue upwards. If the market was going downwards and there was a bit of an unexpected disaster, it would fall more heavily for about 2 or 3 days and then continue that sort of slow downwards projection. So basically it has a 2 or 3 day effect on the share market. And on average, the usual decline is about 3%. Now, that's an average, so sometimes it'll be nothing and other times it'll be a lot more than 3%. And I know this seems crazy when you think about certain disasters. I mean, we all remember that horrible Boxing Day tsunami in 2004, and the market only declined by 3.8%. And the Haiti earthquake in 2010, that caused a 6.6% decline. And so you may be able to argue to say, yes, a lot of these disasters, they happen in countries that don't actually have much of a correlation between the S&P 500 as in the American share market. So what about when a disaster actually hits the United States itself? Say like the Hurricane Katrina, for example, in 2005. Can you guess what happened to the share market here? It actually rose by 3%. That's right, it didn't fall. When the hurricane actually hit American landfall, the share market actually rose. Okay, but what about a disaster in basically the city that hosts the American share market, New York? That's right, 9/11. So we've all heard about how big the 9/11 crash was. What's quite often overlooked is that the market was crashing before 9/11 happened anyway. Before those planes actually hit the tower, the markets had fallen by 16% in the weeks leading up to the attacks. And so it's very hard to attribute what was actually due to the market falling anyway and what was actually due to the 9/11 attacks. Obviously, there definitely would have been some degree of an effect, but how much that effect actually was, it's basically impossible to calculate. But what about the Pearl Harbor attacks? Well, when Pearl Harbor happened, the American market indexes fell by 11%, and it wasn't too long for them to recover back to where they originally were before the Pearl Harbor attacks. Okay, so what about other countries' share markets with their disasters? So say the Japanese market, for example, with the tsunami and Fukushima nuclear plant incident. Well, when that happened, it caused an 8.2% crash on the Japanese index. And unfortunately with this, similar to 9/11, it is argued that much of a downwards movement would have happened anyway without the incident because the market was sort of moving downwards on its own for other reasons. Okay, so what about the Los Angeles earthquake of 1994? It had zero effect. No positive, no negative. Alright, let's talk about something huge for the world then, like say Chernobyl. Can you guess what effect that would have had on world share markets? Absolutely zero. Just like the LA earthquake, nothing positive, nothing negative. So that basically covers disasters. To cut a very long story short with disasters, overall there's basically a bit of a net, very short negative effect after a disaster. So now we'll move into the next point, elections. So this isn't always a disaster. Sometimes it's a great thing. I suppose it depends on what candidate you support and who wins what elections. So with the elections, I found that in countries that are not the United States, it actually has very little effect. And so I actually could not find any correlation between economic performance between the Labour or Liberal Party in Australia or between the two major parties of any other country. So when talking about how politics affects the share market, I really focused on the United States because the United States just seems to lead the way, and then everyone else just seems to sort of be in a bit of a correlation with the United States market. And before showing these political results, I just want to really point out that I personally am politically neutral. I'm purely going about the numbers here. And it's not that I'm afraid of an argument. I mean, if you want to argue with me in the comments, I'll be happy to argue with you about who is the best Ninja Turtle. Does ice cream belong with pineapple pizza or something like that? You can argue with me about that. Or should dancing be considered a sport? I mean, these are all things that I'll be happy to argue with you about until the sun comes down. But one thing that I will not engage in arguments about is politics. So my source here was macro trends, where basically you can look at how presidents are performing in real time. And so you can see the numbers here where you can find the growth of their entire administration, whether it be 4 years or 8 years, and divide it by how many years they served, and then get the average per year return. And so with Bush Sr., it was 11.87%. Bush Jr., as it was 4.93%, Trump was 15.75%, Clinton was 26%, Obama was also 26.41%, and Biden at the moment, he is tracking at 16.61%. And so I'll let you look at those numbers there and make up your own mind, and I do not want to give a political opinion, but I did notice that one party is sort of performing economically better than the other party. And anyway, moving on to the last catalyst for things that may affect the markets, and that is bankruptcies. Bankruptcy? That isn't something that I'd like to subscribe to. I'm sorry, I don't know what came over me. So, bankruptcies. How much do large, too big to fail bankruptcies actually affect the share market on a long-term basis? So there's a reason why I saved large bankruptcies for last, because unlike the other three categories, it actually does have a major effect on world share markets. And unfortunately, with bankruptcies, usually they're triggered by downwards moving markets anyway, and then it'll trigger the said company to go under, and then that'll cause further bankruptcies. And so when trying to analyze the damage of an individual firm's bankruptcy, it's like trying to find how much damage the middle domino did on a set of fallen dominoes. It's very hard to pinpoint, but when you actually collate the data together, it does show to have a very large effect. And the most obvious example that I can use for this domino metaphor is Lehman Brothers. If the subprime crisis had not happened and the markets are not falling anyway, Lehman Brothers probably would have been okay. But then with the falling markets then tipping Lehman Brothers to fall over, the subsequent damage that Lehman Brothers did to the rest of the market was it was huge. So how much of that can be attributed to the falling market and the subprime crisis, and how much of that can be individually attributed to Lehman Brothers? But with all the data being correlated together, many data analysts point that number at 24% approximately. And now let's move on to other big famous bankruptcies. And so for those of you who are a little bit older than myself and people who are my age, you may remember Enron, which is an energy trading company in the United States. And they filed for bankruptcy about 3 months after 9/11. Enron themselves, they did actually collapse the market by about 27%. Now for any Aussies watching this, you may remember ABC Childcare, and that had zero effect in 2009. So to conclude on how major historical events or usually disasters affect the share market, with war, the share market performs slightly better during war times than during peace times. For disasters, that is a temporary short-term hit, and it usually recovers pretty quickly. For elections, it's all about America, and there is one side that seems to deliver a better performance than the other party. And for bankruptcies, it's like trying to blame the middle domino on a falling domino effect. And so when the markets are going downwards, if you do see a headline about a bankruptcy, it could be a bit of warning to get nervous. So out of all of these major events themselves, you'll find that between the wars, the disasters, the elections, and the bankruptcies, all of them recover usually within about less than a year. If you are getting a little bit nervous,